Hi, everyone. Welcome to another episode of ETF 360. I'm Cinthia Murphy, investment strategist at TMX VettaFi. And today I'm really excited. I'm joined by Catherine LeGraw, who is a lead portfolio strategist at GMO's asset allocation team. As you know, GMO has a deep history, deep bench of expertise across investment teams, interesting products in the marketplace. And I'm really excited to catch up with Catherine today. Catherine, let's start strong here and just give me your view on the current market environment. How would you characterize it?
I would say today, in that classic battle between greed and fear, greed is definitely winning. The S&P 500 index is up nearly 40% since early April lows, which is a remarkable rebound. But if you focus on more speculative segments of the market, things like artificial intelligence related stocks, unprofitable technology companies, Bitcoin sensitive names, those groups are up 75 to 200% in just 6 months. These are companies that are priced for incredibly optimistic outcomes that just may not materialize. So the sentiment seems driven by a fear of missing out, and investors appear willing to pay any price for hot stocks.
So it sounds like, if we were to put this in a word, it's kind of a speculative environment. There's a speculative wave. How does GMO as a firm, from an investment philosophy perspective, is navigating this speculative moment?
At GMO, we don't get caught up in the latest mania. We stick to our investing discipline, which is focused around assessing an asset's fundamentals and then being judicious about the price that we're willing to pay. In my opinion, as market fervor heats up and things get a bit frothy, an equity investor's best defense is an unrelenting focus on quality. GMO's markers of quality include a durable, profitable business model and a strong balance sheet. We find that stable, profitable companies with low debt are safer, they're less volatile, and yet they still outperform over the long term. A quality bias has an insulating force in your equity portfolio, and shifting to higher quality stocks can mitigate some downside risk. So, if you are interested in increasing the quality of your equity portfolio in response to this speculative frenzy, GMO's active ETFs could help. QLTY is the ticker for GMO's active US high quality ETF, and QLTI is the ticker for GMO's international high quality ETF.
So within this quality sleeve or beyond, what stands out to you as interesting opportunities in this environment?
I think one of the most interesting opportunities in today's environment, and the one that I'm most excited about, is actually value, because value is a true dislocation today. Value stocks are trading at one of the widest discounts ever compared to growth stocks. They're third percentile versus history. I mean, value's rarely been cheaper. We estimate that value needs to go up 60%, beat growth by more than 60 percentage points to go back to historically normal relative valuations. At GMO, we don't think that just buying the cheap half of the market earns you a persistent return premium, but today we're betting big on value because value is priced to win. And across our dynamic asset allocation strategies today, our biggest active position is value.
So let's dive a little bit into that in the concept of how does a value index capture this opportunity today versus how GMO is capturing this value opportunity today.
Well, starting with the value indexes, there are three problems with value indexes as I see it. First, value indexes rely solely on backward looking reported financial data, which doesn't fully reflect a company's fundamentals. Second, value indexes purposely avoid quality and growth characteristics, which are just lovely features for your equity portfolio. And finally, value indexes inefficiently deploy capital across half of the market at market cap weights. So, my concern about value indexes is that they're not set up to fully capitalize on the value dislocation because they're not designed to pick out those truly mispriced names.
At the firm, you guys are active managers, so you are putting these types of screens to separate, the, I don't want to say the junk in value, but the stuff that it could be more value trap than value opportunity?
Yeah, so we do multiple things to fully capture this value dislocation. First, we've painstakingly restated the balance sheet and the income statement for every company in our investable universe so it better reflects that company's fundamentals. To give you an example, we capitalize research and development expense, and then we record that on the balance sheet as an asset. It's the company's intellectual property. We don't just look at backward looking data, we also create forward looking projections. So for every company in our investable universe, we're creating a projection of that company's profitability tailored specifically to the company's unique characteristics, including the company's quality and their growth potential. So we can get a better assessment of the true fundamental value. And when we allocate capital, we're going to put our capital to the very best opportunities, which is in this opportunity, the value dislocation, the deep value cohort, the cheapest 20%. We find that when value wins, deep value always wins by more. So to access GMO's approach to value, we have active value ETFs. GMOV is the ticker for our US active value ETF, and GMOI is the ticker for our international value ETF. And to your point on junk, no, the holdings aren't junky. We're looking for good companies at great prices. And unlike the value indexes, we're explicitly including growth and quality into our assessment of a company's fundamental value. So we're not capturing a group of low multiple stocks. We're getting stocks that are genuinely mispriced relative to the underlying fundamentals. If you're curious, definitely take a look at the top holdings in GMOV and GMOI. You will find very stable, profitable companies like JP Morgan, Qualcomm, Johnson & Johnson that just happen to be trading at extremely attractive levels. I think these are the stocks that are just getting left behind in today's speculative frenzy, and they're just wonderful bargains for your equity portfolio as a result.
What I love about all this is that one of the big things that comes up when we talk about value is that concern that, is it value for a reason? The concept of, are you getting good names in there or a lot of noisy, value traps, as we call them? So let's talk a little bit of implementation. GMOV, which is your US value portfolio, US equity value portfolio, and GMOI, which is your international equity value portfolio. Give us some implementation ideas. Where do they fit in a portfolio? How should you consider placing them in the mix?
There are a few different ways that these ETFs can fit in an investor's broader portfolio. First, GMOV and GMOI are a nice substitute for existing passive or active value exposure. Because we're going deeper into value, we expect to outperform traditional value approaches when value wins. If you don't have any value exposure today, GMOV and GMOI can be used to take an opportunistic bet on value. So value is deeply dislocated today, and we believe it is priced to significantly outperform growth in a reversion scenario. If you were ever going to take a value position in your portfolio, now is the time. And finally, you could just use these ETFs as a way to diversify away from the very expensive and concentrated S&P 500 index.
Catherine, if folks want to learn more about these strategies, about GMO as a firm, the different products, and the investment methodology, where can they go?
Oh, if you'd like to learn more, please visit our website, gmo.com/ETFs.
Catherine, it's been a pleasure. Thank you so much for sharing. This is really compelling stuff, especially as we prepare for another year of portfolio decisions. Really exciting to have you here. Thank you for joining us today. Folks, this was another ETF 360. For other episodes, check out our YouTube channel. Thank you very much, and we'll see you next time.